Hello, everyone. I am Dr. Deborah Toohey, and I am very happy to be a part of your Current and Emerging Technologies Symposium this week. And Dr. Babb has asked me to speak about banking, since that is my background, and how information technology has been a huge part in the financial services industry. So we're going to learn about, first starting with the history of banking, the history of banking itself, and then on to the present technologies that exist. And IT is a huge part of banking right now. And also, what are those future emerging technologies that we will see in the financial services sector? And there's a couple of nice videos I have for you all, and also something you can do in groups that I'm sure Dr. Babb can assist you with, to read some very good literature on the topic that is out there that I found for you, and have a discussion in your groups about some of the topics that I pose. So let me tell you a little about myself. I started out working for the IRS. I guess that would be expected to somebody in my line of work. And I examined tax returns for them in tax season for a couple of years, and kind of got the idea that I enjoyed financial data, and wasn't quite sure what to do with it, but ended up through happenstance at Citibank in New York. So that was quite a lucky break for any future banker. And I was just a bank teller, so a lot was not really decided upon at that point. It was all very new, uncertain, but I got the banking bug. I went on to become a branch manager at Citibank, and then the controller and vice president of a credit union, and on to bank president and board member for a small local bank. So I've followed all of these trends over the years. Technology is a huge part of financial services, and even though when I first started out, it didn't really seem like technology barely had a footprint in my bank, barely, and I'll get to that in the history of banking section for you. However, it did have a presence, a huge presence in the back offices that I had not seen yet. And of course, compared to today's standards, you wouldn't consider that really much of a presence, but it was extremely critical to the safety and soundness of the institutions. And so currently, I also teach banking and financial services for another university. And so I just wanted to give you a little bit about my background. So let's start off with some of the current concerns in IT, in banking. And what we have up here is the FDIC examinations. The FDIC, the Federal Deposit Insurance Corporation, is that institution, that government institution that insures banks and some other institutions too, some savings banks, that also want to have their insurance. And that came about because of the Great Depression. 1929, monies in the banks were not insured by any government agency. And so one of the worst parts of the Great Depression was that all the money in the banks disappeared. And as you'll see in one of the videos that I have for you, how fragile that system is, how it's based on trust, and how a run on the bank can probably destroy almost every bank that exists. And it's not that difficult to happen. So there's a lot of trust going on. And part of that trust came about after losing it during the Great Depression was the formation of the FDIC. And they started off insuring accounts, I believe, at $25,000 per account, something pretty low. And it is now up to $250,000 per account. Those kind of actions brought back the confidence to the consumers to put their money in the bank, because for many years there were people that had lost everything in the bank and were keeping their dollar bills under their mattress, as maybe you've heard stories or know people from way back, grandparents, great-grandparents, and it was truly the way it was. So putting on that extra layer of insurance, the FDIC government insurance, did bring back some of that confidence. So the FDIC, because they provide this insurance, they have something they want in return. First of all, they charge a fee to all the banks that ask for their insurance. They charge a fee based on the size of the bank, not on the safety of the bank. It's not risk-based or anything pricing. That would be interesting. But they have also the right to do an examination of the bank's records at any time. So you can find, and I have saw, where the FDIC shows up at the bank unannounced, sometimes announced, but also can be unannounced, to do an examination of the bank. And a big part of that exam, which we're focusing on because of our topics this week, would be to examine the information technology of the bank, which right now is a huge part of the institutions. So some of the topics are the risk-based program that applies to all insured institutions. Also to look for the top-down or management-centric focus, flexible use of work programs, and also that the IT examinations will be combined with the safety and soundness, or the SOS examinations. So you will usually see the FDIC examiners show up, and their focus will be both. And their resources are limited, so they're usually going to combine them into one examination. But anything they want to do is truly up to them. Some of the things that they focus on during the examination is risk assessments, and some of these are audit topics. So if you want to delve into them further and you have an interest in audit, that's where you would find more about these topics. Controls, and I'm sure you're all familiar with lots of controls. Independent review and testing, again, part of the audit function. The business continuity management, do they have a plan? What is it? Is it good? Service provider oversight, and we'll see that in a moment. And lastly, the board and management oversight and required reporting by those entities. So there are ratings, composite rating only. We want to see the quality of the information security program, that it is management centric. And we will look at how that is arrived. What do they normally find? What are some findings? Let's take a look at some of those. All right, so a very, very hot topic. Are they safeguarding customer information? And you can imagine all the incidents that you read about data breach. You can only imagine that one of the most powerful places to attack would be a bank, right? The amount of data that is held by the bank is some of the most personal and financially rewarding data to breach. So extremely important. And a lot of this is outlined in GLBA. And if anyone's heard of GLBA, that's the Gramm-Leach-Bliley Act, and that was enacted in 1999. And just a little background on that too for you all is that the main purpose of that regulation was to repeal a lot of the Glass-Steagall Act of 1933. So we found that a lot of institutions were getting into the banking business and were not really banks. They were bank wannabes, like State Farm Insurance, Ford Motor Credit, lots of places. So when that happened, Congress enacted the GLBA, and it also goes by the name of the Financial Services Modernization Act. And it really set down the rules for these banks and also these wannabe banks. And at this point, and even going forward to today, there are many banks and financial institutions that are not banks but are subject to the same regulations because of the services that they provide, which are sometimes identical to the bank. So we see sometimes there is a program for GLBA. It might be weak or out of date. And if you look at the first bullet point, possibly a poor independent review process in the compliance area. So either it wasn't done properly, which would be annually, at least annually. Maybe it was not done independent, or it was not fully comprehensive. There might next be poor risk assessment, or it might be out of date too, either one. It could be weak vendor management program to ensure bank customers' info is adequately protected. So we're going to deal with a lot of vendors in the bank. They're going to have access to some of our data, certainly not all of our data, but those, we are responsible for those too. Next, is there weak documentation that the oversight is being taken seriously by the board of directors and senior management, president, vice president, CFO, and so forth. Next that might happen is a weak incident response program. And there is guidance provided on that. You can see where to get the guidance on that one. Is there a weak training program? All of these training programs are required, and don't be surprised if they walk up to your IT staff or your senior management and ask them all about the controls and audit procedures and protection of customer sensitive data. And the staff must be trained on an ongoing basis throughout the bank, but especially for the IT section of the audit, it would be your IT department that would have to know a lot. And if the training program is inadequate, outdated, or even maybe not done frequent enough, any of those can trigger a problem that the FDIC would find. So we see that in risk assessment, it's going to cover anywhere the sensitive information is transported, processed, stored, destroyed, no matter how it got there, whether it was through people, paper, or technology. So we might see a combination of all of that. And it covers the information that the bank held for its entire life cycle. There's retention record statutes that is another topic, but there's certain requirements for how long to retain certain data. Some of the weaknesses are it might not be enterprise-wide, so you might have a certain department that is not in compliance, or it does not detail how the risks are mitigated, or does not detail how controls, mitigation strategies are tested. And like we said, on an annual basis, at least an annual basis, the status of the program covers all the items below. Overall status, are there any material risk issues? Put the bank through a full risk assessment. Review risk management and control decisions. Oversight of your vendors, whether it means actually going over to their location and testing, or whether you will accept testing from their auditors. And that would be something that would be individual per institution, whether the relationship would warrant on-site testing done by the bank staff or accepting third-party testing. Then the results of the testing, making sure that everything is documented in the board of director minutes if there were any security breaches. And as we see here, it says to document even if there were none. And that shows that you are reporting them. If there are none and you don't say there are any, then these examiners cannot prove that you're even discussing breaches. And next, recommendations for program changes, if any. So let's look at third-party oversight. There's 3 reasons for the bank to conduct the third-party oversight. And the first one is that these third parties have a lot of access to very sensitive consumer information. And are they prepared to handle the secure measures that it takes to have customer balances, customer social security numbers, business tax identification numbers, addresses, lots of information. Also, the third parties are critical to the operation, right? So we need to prove, are they viable financially? Are they going to be here tomorrow? Because they may not be easy to replace them quickly. And do they have a good business continuity plan? And is it tested annually? So you're going to be getting a lot of reports from these third parties that you work with at the bank. And you are going to be reviewing those or doing your own testing on your third parties. And lastly, to ensure that the relationship doesn't expose your bank to excessive reputational, transactional, credit, no legal issues, liquidity, and compliance risk. So that's what you want to ensure with the third parties. IT audit. So you're going to have your internal audit team at the bank. And is the audit program weak? It needs to be reviewed every year. And if there are high risk areas, are they receiving the attention that they need? And they will speak to your auditors about that directly. So onto business continuity planning. These are some problems that can arise. Maybe the plans are obsolete, out of date. They may not cover the entire enterprise. Maybe the bank has taken over another bank since the plan was enacted and it's not covered in an update to the business continuity plan. Possibly the plan does not prioritize or does not prioritize accurately. Have all the plans been tested? And again, are the personnel trained? And you need proof of the training by your compliance officers in records, in the minutes, to show that the training has been done, updated, and done on a continuous basis. User access. And so we need to have periodic reviews of user access on all systems. And that I'm sure you're very familiar with by now in other areas. We also have to look at the automated clearinghouse, which is ACH, remotely created checks, and merchant capture. And ACH are those direct deposits that are either deposited or withdrawn throughout the bank on a minute-by-minute basis. And again, we must make sure that these clearinghouses are doing everything to protect us legally, liquidity-wise, risk-wise, credit-wise. Is there a system in place to monitor the activity and returns? Because there are returns through the ACH system, so are things being monitored and reconciled? And just a little bit about who these third parties can be, how they're defined. Account relationships with entities that process payments for other businesses. We might have alternative payment types, electronic checks created through remote deposit capture. These have maybe never even had a paper form, which is very common right now. So banks are providing the channel for clearing and settlement of not just the checks, but the ACH transactions, ACH debits and credits, payment cards, and more. And they differ from traditional banking business relationships where the transactions are made on behalf of a bank customer. Here are some businesses that create a challenge for third-party payment processors. Just have them up there. Some unique types of businesses, as you see. I can think of a few more. See if you can think of any more too that might create a challenge. And here are some recent cases. We see the regulators observing an increase in the number of problem cases involving payment processors. Most cases involve a failure to conduct appropriate due diligence and monitor transaction activity. The inappropriate use of remotely created checks or demand drafts, which are very similar, that never existed in paper form. The payment processor could be targeting smaller banks that may be seeking alternative non-interest income streams. And lastly, challenges exist when there is not a direct customer relationship with the originating business. So what can they do? What can they do? What can these regulators do when they find these violations? Well, they have a lot of tools to make sure that these items are remedied. And what they can do is they can, if you see some of these listed here, there can be restitution to customers. And we've seen that. We've seen that with Wells Fargo a couple of years ago. Other banks all the time. There can be civil monetary penalties, cease and desist, restriction on operating activities. Those are the main things, the most common things that can be done for enforcement. So here's just a little tip, is that of course we know that those that are violators might be avoiding detection, and that these problem businesses may go to great lengths to avoid detection by both the banks and the payment processors. If you see on the last bullet, the strategies to avoid detection include use of multiple banking relationships, and that's layering everything. Misleading ownership declarations, of course, trying to muddy up the waters by who are really the owners. If you have consolidated return processing, makes things more complicated to unravel. And if there's multiple company names for the same entity. Next, we have some red flags to look for. Is there a high level of consumer complaints? Do we have a high level of returns and chargebacks? And that can be with checks, that can be with credit cards, can be with various things. Are we unable to verify merchant information? Is there unexpected volume? Were there any other penalties levied against the institution or law enforcement inquiries? And here's our third-party risks. They can be operational, credit, compliance, legal, this we went over before. The reputation would be through customer complaints, return items, possibly abusive consumer practices, and then the Bank Secrecy Act and anti-money laundering compliance. That's all through money laundering. And the bank has minimum, and it's all capitalized, minimum responsibilities. Doesn't mean that you can't go beyond that. So we have to establish comprehensive policies and procedures, review all the contracts, establish sound and enforceable contractual agreements with all the parties, evaluate due diligence, perform in-depth and/or enhanced due diligence, perform your adequate risk assessment, ongoing monitoring, establish and maintain adequate reserve accounts, and ongoing training. If you notice, training is the recurring theme in bank operations, including the IT area. So as we see, these third-party payment processors, they are not required to follow the same BSA and AML obligations that FinCEN is requiring of the banks. And so they can be used to assist in illegal or high-risk activities. And that is the risk in those TPPPs, because when you have the Bank Secrecy Act and the anti-money laundering laws to comply with, there's going to be a lot more safety, although of course there are still incidences all the time, but there's a lot less of them in banking as compared to the third-party processors. So the bank retains ultimate responsibility for all the transactions that flow through the bank. And then they are going to be responsible for doing the SARs, which is the suspicious activity reports, because no other party would have done them. The bank has to do them. And the bank has to have understanding of each merchant to identify unusual activity. So be aware of how they operate. And just some other things with the third-party processors. Reliance placed on the TPPPs for initial or ongoing tasks need to be verified at least periodically by an external or bank audit of the policies, procedures, and processes. So that can be an audit by your internal audit department. It can be your outside auditors, but it has to be at least annually. So that is some idea of what is expected during a bank examination from the FDIC, and specifically on the IT department of the bank, which filters through to all the different departments. There's many other examinations and audits that the bank undergoes. So this is just one. An FDIC visit is just one of many ongoing examinations and audits that the bank will deal with during the year. And it becomes a part of routine monthly expected activities. Not FDIC, of course, but the combination of being examined and audited is just a way of life in the banking system, and hopefully you agree, appropriately so. And that's what we have on the IT portion of banking through an FDIC examination. So now that we see some of the current regulations involved in IT and the bank, let's rewind and talk about how this all began. And banks began thousands and thousands of years ago. I believe history tells us around 2000 BC. And of course, it was in nothing of the format that we see it today, of course, besides based on the fact that there wasn't any credible currency, and there certainly wasn't IT. But the bank did start around that time, not anything like what we know it is. And I have a little video to share with you all. And if Dr. Bab can adjust the volume if needed on it, it might be a little low. But it was something cute that I found, and even though it's a cartoon, it's actually quite true, even though it's put in a very friendly format. So here you go.
Most of us believe that banks lend out money that has been entrusted to them by depositors. Easy to picture, but not the truth. In fact, banks create the money they loan, not from the bank's own earnings, not from the money deposited, but directly from the borrower's promise to repay. The borrower's signature on the loan papers is an obligation to pay the bank the amount of the loan plus interest, or lose the house, the car, whatever asset was pledged as collateral. That's a big commitment from the borrower. What does the same signature require of the bank? The bank gets to conjure into existence the amount of the loan and just write it into the borrower's account. Sound far-fetched? Surely that can't be true. But it is. To demonstrate how this miracle of modern banking came about, consider this simple story, the goldsmith's tale. Once upon various times, pretty much anything was used as money. It just had to be portable, and enough people had to have faith that it could later be exchanged for things of real value, like food, clothing, and shelter. Shells, cocoa beans, pretty stones, even feathers have been used as money. Gold and silver were attractive, soft, and easy to work with, so some cultures became expert with these metals. Goldsmiths made trade much easier by casting coins, standardized units of these metals whose weight and purity was certified. Well, to protect his gold, the goldsmith needed a vault, and soon his fellow townsmen were knocking on his door, wanting to rent space to safeguard their own coins and valuables. Before long, the goldsmith was renting every shelf in the vault and earning a small income from his vault rental business. Years went by, and the goldsmith made an astute observation. Depositors rarely came in to remove their actual physical gold, and they never all came in at once. That was because the claim checks the goldsmith had written as receipts for the gold were being traded in the marketplace as if they were the gold itself. This paper money was far more convenient than heavy coins, and amounts could simply be written instead of laboriously counted one by one for each transaction. Meanwhile, the goldsmith had another business. He lent out his gold, charging interest. Well, as convenient claim check money came into acceptance, borrowers began asking for their loans in the form of these claim checks instead of the actual metal. As industry expanded, more and more people asked the goldsmith for loans. This gave the goldsmith an even better idea. He knew that very few of his depositors ever removed their actual gold, so the goldsmith figured he could easily get away with lending out claim checks against his depositors' gold, in addition to his own. As long as the loans were repaid, his depositors would be none the wiser and no worse off. And the goldsmith, now more banker than artisan, would make a far greater profit than he could by lending only his own gold. For years, the goldsmith secretly enjoyed a good income from the interest earned on everybody else's deposits. Now a prominent lender, he grew steadily richer than his fellow townsmen, and he flaunted it. Suspicions grew that he was spending his depositors' money. His depositors got together and threatened withdrawal of their gold if the goldsmith didn't come clean about his newfound wealth. Contrary to what one might expect, this did not turn out to be a disaster for the goldsmith. Despite the duplicity inherent in his scheme, his idea did work. The depositors had not lost anything. Their gold was all safe in the goldsmith's vault. Well, rather than taking back their gold, the depositors demanded that the goldsmith, now their banker, cut them in by paying them a share of the interest. And that was the beginning of banking. The banker paid a low interest rate on deposits of other people's money that he then loaned out at a higher interest. The difference covered the bank's cost of operation and its profit. The logic of this system was simple, and it seemed like a reasonable way to satisfy the demand for credit. However, this is not the way banking works today. Our goldsmith banker was not content with the income remaining after sharing the interest earnings with his depositors, and the demand for credit was growing fast as Europeans spread out across the world. But his loans were limited by the amount of gold his depositors had in his vault. That's when he got an even bolder idea. Since no one but himself knew what was actually in his vaults, he could lend out claim checks on gold that wasn't even there. As long as all the claim check holders didn't come to the vault at the same time and demand real gold, how would anyone find out? This new scheme worked very well, and the banker became enormously wealthy on the interest paid on gold that did not exist. The idea that the banker would just create money out of nothing was too outrageous to believe, so for a long time the thought did not occur to people. But the power to just invent money went to the banker's head, as you can well imagine. In time, the magnitude of the banker's loans and his ostentatious wealth did trigger suspicions once again. Some borrowers started to demand real gold instead of paper representations. Rumors spread. Suddenly, several wealthy depositors showed up to remove their gold. The game was up. A sea of claim check holders flooded the street outside the closed doors of the bank. Alas, the banker did not have enough gold and silver to redeem all the paper he had put into their hands. This is called a run on the bank, and it is what every banker dreads. This phenomenon of a run on the bank ruined individual banks and, not surprisingly, damaged public confidence in all bankers. It would have been straightforward to outlaw the practice of creating money from nothing. But the large volumes of credit the bankers were offering had become essential to the success of European commercial expansion. So instead, the practice was legalized and regulated. Bankers agreed to abide by limits on the amount of fictional loan money that could be lent out. The limit would still be a number much larger than the actual value of gold and silver in the vault. Quite often the ratio was 9 fictional dollars to 1 actual dollar in gold. These regulations were enforced by surprise inspections. It was also arranged that, in the event of a run, central banks would support local banks with emergency infusions of gold. Only if there were runs on a lot of banks simultaneously would the banker's credit bubble burst and the system come crashing down.
Okay, let me pause that. And what I want to do is I just want to give you a little more recent history, because that, of course, is many, many years ago that we experienced items that were discussed in the video. But even in more recent times, for example, when I began in banking, I got to see a lot of technology leaps and bounds. And one of them, and these might seem so commonplace to everyone now, but one of them was the implementation of the debit card. And that really was, the technology was there. You'll find with a couple of these things in banking, the technology was there, but the public, the consumers, the customers were just not ready for it. I remember with debit cards, trying to implement them at my bank, and my board members gave me a lot of resistance. We were away at a retreat to come up with a strategic plan for the coming year of what products and services we might add. And I remember many of them saying, why does somebody need a card to allow them to withdraw money that they already have when they can just write a check? And they understood, the value of a credit card, because you may not have the money yet and you're borrowing it. But why a debit card? Why do we need a card to represent what they could just write a check for? And I remember, that meeting so many years ago to this day, considering how so many people carry debit cards right now. Now, in that little retreat, I was able to convince the board. I was a member of the board, but I wasn't the chairman of the board. So they did have a lot of trust in my research, and they didn't see that it was necessary, but they agreed to allow me to implement a debit card program. So it's kind of comical, so many years later, things that we see as emerging technologies that may not take off, or just may not take off until many years later. The technology is there, but the consumers don't even know they want it yet. Another example of that is the ATMs, the automatic teller machines. And for that, they were originally, I had to look this up for you all, I never really thought about when they were invented, but they were invented sometime in the 1960s. I didn't know that until recently when I looked it up for you. But, and there's some controversy over who actually invented the first ATM. It was very basic. All it did was you would put in some sort of chip and the machine would hand you a predetermined amount of money. It was very complicated though, because the communication between that machine and the bank had to be in close proximity, even on the grounds of the bank, because of the lack of technology that we have right now. And a lot became simpler with over the years with having great operating systems like we have now that can interface. But there's some dispute as to who actually invented that first ATM, and 3 different countries, I think, that are taking credit, and many people. So the bottom line is nobody even used or thought about using that ATM in the 1960s. But the wheels had started. And fast forward into the 1980s. I was with Citibank in New York, and they were one of the leaders. They weren't the only one, but they were probably the biggest player at the time to really get the ATMs up and running. They felt that it was a way, their plan was, because I was part of a committee, to implement not just the ATMs that we had started, but to make each branch tellerless, where there would be no bank tellers. There would only be representatives to guide and educate the customers how to use the ATM. I know it sounds so comical considering how far we've come since the 1980s, but to make the customer more comfortable with the ATM if needed, of course, and then the branch would have almost no overhead. Well, that project failed. It failed miserably. Thank goodness I was only a very young newbie, and therefore, if any heads would have rolled, it had nothing to do with me. But I was part of it, and I got to see how we were still trying to create that demand for the customers that they didn't even know they had. And look how many ATM transactions occur now. Look how many grandmas carry ATM cards, right? So not only can we just withdraw cash, we can do so many things at the ATM. And since that time, many banks have really been able to stop their drive-through services, cut their hours in their branches. And I do have to mention it's an expensive transaction. ATM transactions go through a lot of parties. You know, sometimes you just go to your bank to withdraw from your account, and that's not a very expensive transaction for the bank. But when you go to another bank to withdraw from your bank at the ATM, that transaction starts adding up. There's fees all along the way. There's the fees from the host bank that you're at. There's fees from your bank. There's fees from any intermediary that might have been involved in the transfer of the data and the money. And so that transaction can cost the bank, and we all know they might even cost you a couple of dollars, right? But overall, the consumers have required to be able to have instant access to their money. So even if it costs the bank, and there's been different studies, it might, and also I've been involved in juggling the financial part for the bank. It can cost sometimes $3 for each transaction, $4, $5 to the bank for each transaction. but they could not ever take that service away at this point. I think you'll all agree. And the tellerless branches, well, most of us don't even go to a branch anymore. So what Citibank tried to do so many years ago has actually become a reality, even better than their wildest dreams, right? Most of us are sitting in bed, using our smartphones, taking a picture of our check. Check never leaves our hands, and we've made a deposit. So that brings me to another part of the history of IT and banking is the mobile apps and online banking. And I also was responsible for implementing an online banking program at the bank that I was with. And I don't think that was met with as much resistance as the debit cards were, if I recall. But it was successful. It didn't do very much. You know, it was pretty basic. But now, of course, with the mobile apps and the websites, you can do almost anything that you could do in a branch. And so, lastly, in the history of IT with banking, and there's so many things, but I just wanted to highlight a few, is that back until maybe 10 years ago, checks would clear by physically being transported from the bank where you deposited the check. Your bank would have a afternoon pickup of all the checks that were deposited, totaled, photocopied, and then sent via courier down to the Federal Reserve, where they would be run through their machinery, totals taken, the Micker encoding, that funny encoding at the bottom of the check read, and transmitted to the institution where each of these checks were drawn on, and then settled up each night in the middle of the night between bank to bank, who owed who what, how many withdrawals there were to Bank of America, Chase, Citicorp, and whoever. And the physical checks were then actually returned to the customers, of course, at the end of the month. Right now, the physical checks do not leave the bank. They don't go to the Federal Reserve. All of that has been eliminated through the beauty of IT and banking. So that's why I wanted to share that with you. So that's a little bit more about the really, really beginning history of banking, and then on to some of the advancements in technology that took place in the last 30 years in banking. Next, I would like to touch upon the future of IT in banking. So as we see, banking is very heavily dependent on IT. And if you do any further reading, you'll see that the IT affects so many aspects of the bank, not just the parts that we've discussed here. There's so much data mining done in a bank. It is absolutely one of their largest expenses. They want to see what their customers want. They want to know a little bit about marketing. They want to see who to send credit card offers to. And so they're going to have the technology to run reports as to who they should offer a credit card to. You know, you don't want to send out a pre-approved offer to people that will never qualify. It's not going to make your customers very happy, right? So there's a lot of data mining going on at the bank. But what does the future hold? And what do some of the experts say? Will there be cash anymore? Coins, bills? We now have other methods like Bitcoins. And we have no idea what the future is really going to hold, but we have experts that have made some predictions. And what I would like some help actually from Dr. Babb, if possible, is to just kind of separate you all into a few groups, and I can't see who's there, so there is a very nice video on technology and banking into the future, and also a great white paper I have from Berkeley. So what I'd like to do after you kind of find a few people to work with is that we can start with the white paper. It's called Technology and Banking. And if Dr. Babb would distribute those copies for us, you can just sit and read the following article and then discuss it in your group to formulate a group response that you'll share with the class. One of you from each group can share with the rest of us. And after reading the article, here are 2 questions that I'd like you to answer in your group. The first one is, and these I'm sure Dr. Babb can write down for you also, but the first one, explain the process of how Bitcoins work. Quite interesting and quite relevant these days, right? Everyone talks about Bitcoins. Digital assets, very, very, very hot topics. And next, the second question after reading the white paper. Present SWOT analysis for the banks in light of digital currencies and competing payment processors. So I'd like to give you some time, if Dr. Babb can pause my video, to give you some time to read the white paper, Technology and Banking, read it by yourselves, amongst yourselves, and then discuss it in the group and formulate a response for each team to present to the group as a whole. So we can pause this now. All right, the next thing that I'd like to share with you is to get, as we look ahead into the future of IT and financial services, is a intro video that I have which explains fintech. So again, adjust the volume if needed, Dr. Babb, that would be great. And this one is called Banking from Your Pocket Using FinTech.
There's a topic where I can guarantee this concerns each and every one of you in this room today. It is money. But while we like to have money, or even better, a lot of money, we don't usually talk much about it. Well, fasten your seatbelts. Because for the first time, money has actually become a fascinating subject. Something so exciting that they would even let somebody stand up and talk about it at TEDx. So, what's going on? In fact, a global revolution has just started, and it goes by the name of FinTech. This term was made prominent by The Economist in a special issue last year, and Google search volumes have gone through the roof ever since. So what's going on? FinTech is short for finance and technology, and it basically means reinventing the whole way we deal with money, with banking, in a completely new way, based on today's technology. What does that mean? Well, let's run a little experiment, right here, right now. I need a volunteer from the audience. Somebody. Here, the lady in the second row. What's your name? Angelica. Thank you very much. Applause for Angelica. Congratulations, you actually don't have to do anything. So you'll just earned 50 Swiss francs just for your courage for participating, and you'll get the money right away. There's only one problem. I just realized that I didn't bring enough cash with me this morning. So I just need to walk to the nearest bank branch, get some money from the ATM, and I'll be back in a... might be a bit dry for the rest of the audience. I could also take out my laptop and send it to you from my online bank account. But I also didn't bring my TANT generator. And apart from that, today is Saturday. So the bank is closed anyway. So they'll start sending you the money on Monday. So you'll probably get it by Thursday. That's a bit of a bummer. Now, fast forward to this new fintech world. In this world, both of us would own a revolutionary new and powerful device called a smartphone. And with the smartphone, I could send you the money right away here from the stage, and you would have received it in a minute from now. And if you don't yet have a mobile first banking account, you could actually open up right now here in the TEDx auditorium if you're not too loud. This is what fintech is generally aiming to do. Thinking about how we can redesign our banking experience with today's technology. And if you think about it, and if you look at the bigger picture, the internet, the smartphone, they've already reshaped and disrupted entire industries. In travel, we use Booking.com and Airbnb. We don't walk to the nearby travel agent office to book our stay. If you want to watch videos, we stream them online on YouTube or Netflix. We don't drive to the nearest video store anymore to borrow some DVDs and take them home. And by the way, if you younger folks in the audience wonder what video stores have actually been, chances are you would just look it up on Google and not take out your little pocket encyclopedia. So what about banking? Well, isn't it a bit ironic that I could order a full-size plasma TV in the morning on my smartphone, have it delivered the same day by Amazon, but it takes almost a week until Angelica gets her 50 Swiss franc. But I got some good news for you, because the future of finance has now arrived, even in the technologically emerging markets of Western Europe. What does that mean? Well, let's have a look. This is how most of us are used to dealing with money. No matter if you want to save, want to invest, want to borrow, maybe want to send money internationally, we would turn to our trusted bank, either online or walk to the bank in some cases. But now, the same trend that has already appeared in other industries, as we've seen before, has now also arrived in banking, in the industry of money. So now there's an alternative. Numerous startups have appeared which provide services really specialized, and they often do it faster, cheaper, more convenient than the traditional bank. When I shared all of this with my friend Jenny a couple of weeks ago, she in the end looked at me and said, well then, you know, I mean, if this is all that great and wonderful and awesome and faster, cheaper, better, why isn't everybody using it already? I mean, I've hardly heard of anybody who actually uses this stuff, right? I think she has a point there. So the next week, I passed this question on to a friend, Dom, who's working in London for a fintech company. And Dom said, well, you know, Daniel, sometimes I'm reminded of the history of cars. Cars. So the automobile was invented back in 1887, but it took more than 30, 40 years until they finally reached the majority of the cities, although they were faster, in the long run cheaper and more durable than those horse carriages. But people just seem to like their horses. And so I just think people today like their bags. Well, I think he has a point there. And like in those days where people would have warned you of the severe health risks if you drive at breathtaking speed of more than 15 kilometers an hour, like in those days, there are voices that would warn you to use any of those fintech providers or for Angelica to open up this mobile bank account. What do banks actually think about this trend? Are they even taking it seriously? Turns out they do. Silicon Valley is coming. Those were the famous words of Jamie Dimon, CEO of JP Morgan Chase, one of the largest and probably most admired banks in the world. And what he meant was that hundreds of startups are out there tackling those profit pools of banks and becoming a real challenge over the years. His conclusion, however, was not to just ignore them or even fight them to death, but to learn from them in some ways, and in other ways, even partner up with them. I want to leave you with this picture, referring to the CEO of Deutsche Bank, John Klein, who actually said and predicted even more radically, in 10 years from now, we won't have any cash anymore. So just imagine, we would meet again in 10 years from now. We no longer carry around any cash or credit cards, let alone checkbooks. When we jump off the self-driving bus, the ticket is paid for automatically. We walk down the streets and we just quickly catch up with our virtual financial assistant, Alexa. She lets us know that all bills are being paid for, monitored until the end of the month. You got some excess cash and you can just approve your tax receipts, which are already prepared. You decide to do it later on your smartphone. But it's a hot day, so you feel a bit thirsty. You just walk into the nearest store, grab a bottle of cool water, walk out again. Payment is happening in the background. Then you run into Angelica, who already made a fortune out of her 50 Swiss franc by investing in automated robo-advisory, which probably you wouldn't even know because in 2026 we still don't talk much about money. In fact, less than ever. Because money, finance, just faded into the background somehow. It simply works for us. And leaves us with more time for what actually matters to us, what we enjoy doing. Because, after all, there are more important things in life than money. Thank you.
Okay, and I hope that you enjoyed that TEDx video. So now that we have some idea about fintech to financial technology, I also have another video that I'd like you guys to watch. And again, if you can casually stay in small groups that Dr. Bab, I'm sure, can assist you with. And then let me tell you some things to think about as I get this video ready that you're going to discuss in your group and draft a report and have somebody from each group present it to the class. So the first question, what might the future of banking be with all these new technological payment systems? If any future at all, is there a bank in 2020 or 2050? Second question, when and if will there be no bills and coins anymore? What's your prediction for that as a group? Will that day be around the corner? Is it almost here? I know there's times when I'm out with my family and all we need is $1. No one has $1. They have 10 different cards in their wallet and ways to send on their smartphone, and yet not even any coins or cash. Third question, if there is a future for the bank, what might their role be? Will they be evolving to consider still being viable with all these changes And the fourth question for your team, think of some digital assets like the Bitcoins and Zcash and discuss what are the pros and cons of each, because they're not identical. And also, how do they compare to not using digital assets? And then come up with a report that one of you will present to the whole class from each group. So let me load up the next video, which will give you the answers to most of the things that I just asked you, although some of it will be really based on your own predictions from either what you've already decided before today or what maybe you've cemented more after viewing the presentations. So let me load that up for you. Okay, here we go. Predictions. The shakeup in fintech and payments.
Thanks, Karen. Thanks, Robin. And good morning. Today we're going to talk about blockchain, fintech's new railroad. So the medium of money is changing, and it's changing very fast. If you look at the historical backdrop here between wampum, cowrie shells, tally sticks, gold, soon the notion of paper money and this explosion of digital assets well beyond Bitcoin is upon us, all enabled by blockchain technology. My name is Matt Rozak, co-founder and chairman of Block. We're an enterprise software company building out blockchain ecosystems for companies around the world. I've been a venture capitalist for 20 years, so I invested in all genres of technology, also co-founded 6 enterprise software companies. And I've never seen anything as exciting as blockchain technology in my career. And I think it's going to have profound effects on enterprise, government, and especially on humanity. And I definitely want to be a part of that. So we've all heard of and probably even said the old adage, money is power. I believe very soon we're seeing this transition where money is technology coming into focus with some of these digital assets, digital currencies, and platforms and new railroads that are being developed. And so now technology is power. And stay with me here. Marc Andreessen has a very famous quote, software is eating the world. And if you look at the market caps of the largest companies in the world for the last 5, 10, 15 years, something's changed. You look at the GEs, the Exxons of 10, 15 years ago, now it's a completely different universe of companies. They're all tech companies. They're all software companies. They build networks. And something has changed there. Marc Andreessen had a smiley emoji. These guys don't have smiley emojis. This is like, tech as an innovation as a core competency hasn't always been kind of natural. Sometimes it's scary, and so you see some of these stories of just blunders by some famous people here, and even the Western Union, William Wharton, he was offered by Alexander Graham Bell the patent for the telephone, and he's like, what do I need this toy for? And again, new technology, innovation, this whole notion of this tech being a core competency in every single company is imperative. And you see even more recent pronouncements by CEO of Porsche. iPhone belongs in your pocket. It's like, that's a little denial there. And then lastly, look at the final quote by Jamie Dimon, where there's never going to be a non-controlled currency on the planet, and obviously we're seeing Bitcoin proliferate and reached almost 20 billion in market cap over the recent past year. And I'll admit that when I first came across Bitcoin in 2011, I discounted it. I said it's magic internet money, not that interesting. Albeit a year later, I did what I tell people still to do today, which is turn off your phone, lock your door, and study this technology for a day. It's the best advice I could give you. And tech evolution is kind of interesting because when you first experience it, it's not necessarily that intuitive. I remember, and all this transposed in the last 3 or 4 decades. So this is kind of in our lifetime, over the recent past. And I remember buying my first PC. I went to Kmart on my BMX bike. I bought a Commodore VIC-20. I remember using the internet for the first time, which was a Gopher interface. Mobile phone was in a big bag, which was a brick phone over my shoulder. Social, I guess, MySpace wasn't that great. And now blockchain, most people's experience with blockchain has been Bitcoin. And that's been a scary proposition because its initial use case was paying for drugs, right? That was the initial kind of use case that it used. And those were salacious headlines, 3-4 years ago. Now you're seeing $1 billion plus of investment, some of the brightest, smartest people in industries across the world jumping into this ecosystem. So something has changed there. And if you look at these, each technology element, it layers upon itself, it compounds. And I think with blockchain, being able to process payments, micro payments, enabling IoT, Internet of Things, you have some really profound outcomes with blockchain. But what are blockchains, right? It's like this. It's not that intuitive of a technology because it's like, what is Bitcoin? What is blockchain? Fundamentally, blockchains are distributed immutable databases. And you're like, wait a minute, this is like a spreadsheet? Well, it's a spreadsheet, but it's born in cryptography and computer science on a peer-to-peer network. And originally, the notion of a blockchain was invented by Bitcoin, by Satoshi Nakamoto, where a couple things happened. There was a true invention there where you have this digital asset that can't be copied. A Bitcoin cannot be copied. And that's a big deal. We send PDFs and PowerPoints and stuff all over, and we copy those things. We actually send copies to each other. But we have the first digital asset that cannot be replicated. That's a big invention. And then underneath it all, the blockchain, underneath Bitcoin, we have a network, a peer-to-peer network to move that value, and pretty soon it'll be data. And the other thing when you think about blockchains, it is removing trust from the equation. So there's no central intermediary. It is a decentralized network. And so you're trusting the math and the cryptography of the network and not necessarily a trusted third party. So no bank, no government, no credit card company, nobody in the middle. And we'll talk about enterprise adoption and what that means for companies in banking, payments, capital markets today. The one thing I will say, when you think of blockchains, think of networks, think of cooperatives. People are getting together around a technology, around a platform to move data and value securely. Think of it as a network. It's like I always want to say, well, blockchains are network enablement technology. And it's kind of like not as good of a term, but think of blockchains or networks. And banks and tech have not had a great relationship. It's been a love-hate relationship since the days of the internet. And like any great relationship, there's interesting intrigue. There's a fine line between love and hate here. But when banks adopted the internet, they basically used some duct tape to get themselves internet enabled. Y2K came around, they got pressure tested. Another system reset. Mobile came around, some more duct tape to kind of get themselves into the mobile ecosystem. 2008 happened, more pressure testing, resetting systems, reinvigorating systems to see what's working, what's not working. And so some of those were like bullets whizzing by the ear, right? And they were like, hey, we kind of went through it, we kind of figured this out, and banks and financial services companies gone through 20 acquisitions over 20 years and operations in 20 countries. And so there's a lot going on the back end there. And now it's a lot different. There's not just one or two bullets whizzing by the air. There's a machine gun. There's a stampede of unicorns. If you look at robo-investing, peer-to-peer lending, Bitcoin, other innovations around, this is a really big deal. Banks are now some of the biggest innovators and some of the biggest buyers of technology on the planet. And we're seeing that firsthand where they've all entered blockchain. There's not a single bank, insurance company on the planet that even on a board level doesn't discuss blockchain regularly. This is a big deal. It centers around their core competency and what they're going to look like in 10 or 20 years. So now you see this march of the enterprise, march of financial services into blockchain technology, and there's a massive amount of investment here. This isn't just like in the technology, but there's people, there's strategies, there's calorie burn here in all these organizations to figure out what their blockchain strategies are. This is happening right now in real time. And two things are happening here. I kind of view this as there's two worlds under construction. One, you've got banks, and they're kind of reformatting their plumbing. They're developing new railroads underneath themselves. There's huge compliance costs, huge regulatory burdens, capital controls, et cetera. And they're trying to reset their plumbing to get a lot more efficient, to move money internally and externally, cheaper, safer, better, and more compliant. And that's going to take some time. I mean, you look at implementing SAP or Salesforce in a big bank, it takes years and years. So when you do replumbing on new infrastructure, call it blockchain, it's going to take some time. But they have certain advantages. They have networks, they have lots of consumers, they have lots of customers. They have brands. We love brands, right? We're accustomed to brands. And they have a regulatory edge. And so there's a lot going for banks right now to really adopt this new technology and come out the other end. On the other side of the equation, we've got mobile. We've got this proverbial bank of one. And you think about the goat herder in Ghana, the taxi driver in Indonesia, the soccer mom in Brazil. They will never get a bank account or a credit card in their lives. Just won't happen. There's a certain financial access there that just isn't available to them. But they all have a supercomputer in their pocket. And so buying some digital currency and getting into this ecosystem, getting that financial access, that financial sovereignty, opens up a huge market. Tremendous. We've all seen Mary Meeker's stats on what's happening with mobile. And that bank of one is going to be something of consequence. So I just look at these two worlds where you have the plumbing of Wall Street getting reset, redeveloped, reimagined, and then you got the bank of one. And the bank of one, again, banks have those networks, those brands, and that regulatory edge. And some of these unicorns, these whippersnapper companies that are developing apps to create that financial access, that financial sovereignty on a peer-to-peer basis, they don't have that. So some of those are going to interplay in an interesting adoption curve. And the question is, are those two worlds going to connect or collide? It'll be interesting to watch that play out. And so there's no shortage of blockchains on the planet. The innovation in this space is profound. If you look at, there's basically three categories of blockchains. There's public blockchains, we know them as Bitcoin, Ethereum. There's private blockchains, which are railroads for mostly regulated industries, so a lot of banks, insurance companies, etc. And then there's consortia, and these are industrial use cases for banking, insurance, post-trade, etc. And on the public side, there are the blockchain with the biggest network effect is Bitcoin. And the digital currency of Bitcoin is like an equity token in that network. So the more the network does, the more valuable your equity token will be there. And we're seeing that over the recent past in terms of Bitcoin's price going to 1,000. We'll cover that in a little bit. We also have Ethereum, which is a smart contracting platform. We have Ripple, which does a lot of interbank transfers, and Zcash, which is relatively new. But unlike Bitcoin, Bitcoin is pseudonymous, so you can trace it and track it really well. You don't know who the wallets belong to. On Zcash, it obscures a lot of the data, so it's way more private. The transactions are way more private. So Zcash, while you think it's got a utility in maybe nefarious industries of back to Bitcoin 1.0 of buying drugs online, this is for traders of, Apple doesn't want to see what Samsung is trading and vice versa. So you have certain transactions that are going to have use cases for specific industries and specific transactions. On the private side, we have Hyperledger, which is a project of the Linux Foundation. You have Digital Asset Holdings, you have Corda, IBM, building this infrastructure for banks and insurance companies. If you fast forward this movie, you're going to see a lot more public blockchains. There are, aside from the 4 on the screen, there's about 500 others. Everything from the no-name to what you see here, and there will be tons more. There'll be a proliferation of this. Same thing on the private side, same thing on the consortia, and I view that as an incredible amount of innovation, much like the late 90s of the internet. You just have this stampede of innovation, of investment into this new technology. From Block standpoint, the company that I co-founded last year with Jeff Garzik, Jeff's been at Linux at Red Hat for 10 years. He was just elected to the Linux board of directors, was a Bitcoin Core developer. So we wanted to harness some of this demand for enterprise customers vis-a-vis blockchain. And our strategy and our view, if you fast forward this movie, is that it's going to be, interoperability is going to be very key. So it's going to be a multi-network, multi-chain, multi-token world where all these different blockchains, all these different digital assets are going to need to talk with each other. And enterprise adoption has been interesting. I mean, it's we're in conference rooms every day with Fortune 100 companies saying one of two things. It's kind of interesting. On one side, it's like we have identified 10 blockchain use cases. We want to do these 3. Go. We're like, wow, that's super impressive. On the other side, we have household name companies that are like, is blockchain 1 word or 2? You know, and it's emblematic of where we are in the space. The evolution of this technology and the adoption and the education of where we're at, that's very representative. But if you look at the way enterprise customers adopt new technology, think back at the internet. Banks, insurance companies did not just jump on the internet. What they did is they built intranets. Said, let's just, all of us in the room here, let's communicate and collaborate as a group, right? Because we don't want to go on this open internet. It's too unknown. And so we build intranets. And then once we got comfortable there, what do? We build extranets. So we're going to start enabling communication with our partners, customers, suppliers. And then pretty soon the innovation on the open internet got so great that we just flipped the switch and jumped on ready-made apps and networks that were on the internet. Same thing happened with cloud, where early days enterprise customers were looking at hybrid cloud systems, so some data will stay secure, some data will stay in the cloud, and so forth. So the adoption curves and the flight path of enterprise for new tech has been pretty much historically repeating itself. And there's no difference here in blockchain tech, where a lot of those private ledgers, private blockchains are getting adopted by big companies because they're looking at Bitcoin and like, well, I remember it was like drug money, or last year they had a scaling issue, so I'm going to go on Ethereum. Well, Ethereum had this fork, and so enterprise customers, they manage risk. That's kind of what they're doing. So they're like, well, those open source technologies aren't game time ready yet. So while those are developing, while those are getting innovated, I'm gonna build my own intranet, and that's what a private blockchain essentially is. And so when you look at enterprise blockchain adoption, it kind of goes into a risk-adjusted way of approaching this, and I've bifurcated into 3 areas on cost, growth, and transformation. So you're reading a lot about Santander Bank or Goldman Sachs saying banks, insurance companies are going to save 20 billion, 50 billion. Ginny at IBM said supply chain companies will save 100 billion based on blockchain tech. And so the easiest way to adopt a new technology is to say, let's build an internal railroad where we move data or value from A to B, and let's save money doing that. And that's phase 1. We'll just jump in the water, let's get blockchain enabled, and let's get our feet wet. And then let's look at growing markets, expanding new markets, creating new markets. And then ultimately there's this transformation where we really say, as a bank, as an exchange, the core of what we do, one day we're going to have to give away. and build the strategies and the concentric circles around that, the service layers where we're going to make money because we're going to be a network operator or a network participant. And again, this whole notion of blockchains or networks is very, very key. And that the transformation, it's you know, the best example I could give of a transformation strategy would be like China calling India and Russia to say, let's build a blockchain, build a network to jump over ACH or SWIFT or any other blood vessel of value. And so those parties probably wouldn't trust each other, but they don't have to. They have a technology, they have a platform that give them the volume, the throughput, and the pricing to be competitive. And so these networks and the ability to blossom networks over time is going to most certainly move markets and change industries. So let's review 2016. So I was here a year ago talking about Bitcoin, blockchain, and beyond, and had a few pronouncements in terms of what I thought would happen in 2016. And it wasn't too far off. And as a venture guy, as a tech entrepreneur, you kind of like, you make a lot of pronouncements, and you only have to be right on a few to come out the other end, you know, kind of looking good. But that's the nature of venture and startup world. The unicorn there was, I had this, the good, the bad, and the ugly, but I had the good, the bad, and the halving. The good was there's going to be a unicorn born in the ecosystem, and there weren't any private company unicorns that developed, but Ethereum crossed $1 billion, and then Bitcoin added about a half a dozen unicorns to its market cap. And I think the first unicorn in the blockchain ecosystem will show up very soon. I think what's happened is the public blockchains have kind of found an arbitrage, a speculative flywheel there, and ultimately the companies that are building out the fabric of the industry will start to come into focus a lot more, and that'll be you know, like a digital wallet, digital currency provider like a Coinbase or a mining company will probably be one of the first out of the gate. The bad, that's Charles Darwin. You know, that's seeing M&A in the space. And we've seen about a dozen acquisitions in the blockchain ecosystem. Airbnb bought ChangeTip's assets and hired some people. Kraken made several acquisitions. So we're seeing more and more froth on the acquisition side. On the halving, something a little technical here, but every 10 minutes in the Bitcoin ecosystem, there's a reward for processing transactions, and that was 25 Bitcoins. And now, as of July, it went into 12 and a half, and everybody thought that was going to have kind of a seismic effect on the price, and it really didn't. It kind of just like smoothed out, and toward the tail end of the year really perked up on price. So the halving wasn't as major of a story as people thought. And then at the bottom, the enterprise, Wall Street, and Main Street were adoption curves. And the reason why Main Street has got a blowfish is for most of us, at least 3-4 years ago, 2-3 years ago, I mean, even getting my neighbor or brother and sister to get on Bitcoin was not a great experience. And there's a blowfish on there because it was kind of, getting your own Bitcoin wallet was like trying to flay a blowfish, right? You hit the wrong gland and something might go wrong, and you gotta, you know, the experience wasn't great. The form factors and the wallets and the whole experience set with Bitcoin has gotten way better. But the adoption curves for Main Street haven't yet been realized. And I still think people are going through this education process, at least here in the US. In Argentina, in Greece, in China, different story. They're adopting Bitcoin, they're investing in Bitcoin in greater amounts. Wall Street, so this digital asset of Bitcoin, and you take Ether for Ethereum and some of these other equity tokens of these new railroads. Because if you think back of the internet, right? Joe Monegro at USV had this great blog post of fat protocols and thin apps. So internet was a very thin protocol and had fat applications. So much of the value of the internet was captured in Facebook, Amazon, Google, etc. In the blockchain world, you have an equity token into the blockchain, at least on these public blockchains, where the value is captured in this protocol and the applications are a lot thinner. So you capture more value in being a participant and an owner in the network. And so Wall Street hasn't necessarily been as engaged in trading and being as speculative of these equity tokens in the last year, and I think that has to do with some regulatory dynamics of not being able to put in a particular category in the compliance and the rest of it. That is slowly starting to change. We're seeing first ETF on the horizon, and we're seeing regulatory clarity on the horizon as well. Enterprise has been probably the most prolific in terms of adoption. They have really put the gas pedal down in terms of innovation investment. Lastly, China. China's of consequence, and there's a monkey there because this last year was the year of the monkey, and China has the largest Bitcoin trading and the largest Bitcoin mining. But what that's also done is transpose this view of the technology and the concentric circles and the software layers, and the underlying blockchain technology, and how that applies in other industries. So China's been a very big investor in lots of Bitcoin blockchain companies, and is innovating, creating consortia, et cetera. So China's of consequence. So what's in store for 2017? Regulation, I think, is going to be come into the fore. I think on two fronts. One is these baby currencies of Bitcoin, Ethereum, et cetera, aren't babies anymore. They're getting into the $20 billion market cap range and are continuing to grow, and more investments coming in there. So I think there's going to be more thought about how to review these technologies and these digital assets. Transposed against regulators are innovating right now. It's interesting. We're seeing the OCC with a fintech charter that is, was a pleasant surprise. And then on the other end of the spectrum, you see jurisdictional arbitrage between places like Singapore doing fintech sandboxes, the UK, Switzerland, et cetera. And so, will that kind of dictate where the next Wall Street is, right? Adoption, I think the adoption for 2017 with this ecosystem will be very similar to 2016, whereby Main Street will be relatively ho-hum, at least in the US. Externally, will continue to grow. Wall Street will still try and find its bearings on the regulatory box to put these digital assets in, and enterprise will continue to put the gas pedal down. China, again, this is the year of the rooster, if you guys didn't know. So, they will continue to be vibrant in this space. You'll see more and more investment and innovation coming out of China. And then lastly, investment. So I get this question a lot, like, is the hype in blockchain, over, what is happening here? There's so much investment, so much talk. We're not even close to the hype. We're at like 10 or 20%, and I'm like rounding up by like 4x. I had this discussion with this gentleman that ran all these internet consultancies in the late 90s. And I was like, Howard, remember when we were putting like pet food and airline tickets and shoes online? This is like 1,000x different. This is like 1,000x bigger. This is digital currencies, digital assets, true digital identity. This is a big deal. So the investment and the hype and the effervescence in this space is going to be profound. And what blockchain will do, if you look at what internet did to commerce, communication, and retail, will do to banking, payments, capital markets, and 100 other industries. So last one here, Bitcoin 1,000. So this is the recent kind of news. I predicted that Bitcoin will be at 1,000 by the end of the year. It took another 24 hours to get there, and it's kind of gone up to 1,100. It's now back to the 900s. Regardless, this is a psychological milestone. I think when you see Bitcoin at 1,000, and you kind of have this discussion again, everything from CNBC to kitchen tables, about what is Bitcoin, what is blockchain, and I think the evolution and the investment and education in this space continues to evolve in the right way. And lastly, I'll kind of end the way I started. I can't find a better way to spend my time and energy beyond building this ecosystem. I think it's really going to have profound effects on the way business is done, on the way government is run, and on humanity. That financial sovereignty, the financial access is a really big deal. Thank you.
Well, on that note, we have covered now the past, the present, and some predictions for the future with IT in banking. And I'm very anxious to see and hear some of the responses that you all have, that I am sure that Dr. Babb will share with me when she gets back from your meeting. And there's a lot on the horizon. We see where the banks were not always up to the challenge. At times we saw where the consumers were just not interested. We have to really tread carefully with IT and banking because of the sensitive nature of the data. We have to stay in compliance. We don't want to come up with new emerging technologies that will be in violation of anti-money laundering laws. We don't want to make it any easier for suspicious activity to go unnoticed. And I hope that we can continue this discussion somewhere, someplace in 10 years and see how your predictions lined up with how things are in 10 to 15 years. It'll be so exciting. Whether there really will be cash, will there be a bank? What will happen with these digital assets? And it'll be so exciting to follow where this leads. So you have those 4 questions that I want you to mull around in your group, and then someone report to the full class. And again, I'm sure that Dr. Babb can give you those questions again, but those are the ones that I'm most curious about to hear from you. And I want to thank you all for letting me be part of your symposium. I have my website at deborahtuohy.com if anyone wants to follow me there. And I hope that you enjoy the rest of your time in class. And again, I thank you for letting me be a part of everything. So hopefully, again, we will have this discussion down the road. There's certainly a lot that's going to be changing, and we are right in the forefront of it all. Thank you so much, everyone. Thank you.